Welcome everyone to session 2 of our technical analysis course and Bill Williams trading tools. My name is Ali Mortazavi and I'm the head of education at Toronto. Today we will continue our journey into the world of technical analysis by exploring the innovative tools developed by Bill Williams. In our first session, we laid the foundation by discussing the basic principles of Bill Williams' rating system and psychology analysis. Today, we will build on that knowledge by focusing on the specific tools created by Bill Williams. These tools include the Alligator indicator, fractals, and Awesome Oscillator, each of which plays a crucial role in identifying market trends and potential reversal points. So, in today's session, we will cover several key components of Bill Williams' rating system. Our goals here is to understand these concepts thoroughly and to learn how to apply them effectively in our trading strategies before we take a step in our next webinar into the advanced trading strategies that we can use with Bill Williams trading tools. So here is an overview of what we'll be learning today. First, we'll start with an introduction to the Williams system. Just a very short recap from the last session. And Bill Williams, a renowned trader and author, known for his innovative approach to trading. Understanding the core philosophy behind the Williams system, as we got through in our previous webinar, was really essential to provide you with a solid foundation for more technical aspects we'll cover today. So we delve also into the Alligator indicator, one of the key tools in the Williams system. And the Alligator indicator consists of 3 moving averages. If we get through all of the details about that, by measuring the Alligator indicator, you can better recognize trending and non-trending markets. We will see what are the benefits of using these very effective tools to understand the market narrative and also to identify the market direction and also to gauge the momentum. That's going to be really exciting for all traders. And after that, we'll focus on fractals, which are patterns that help identify potential reversal points in the market. Fractals are a critical component of the Williams system and are used to determine support and resistance levels, as well as potential breakout and breakdown points. Then we will introduce the Awesome Oscillator, AOO, another powerful tool created by Bill Williams. The AOO measures market momentum and helps identify potential trend changes. It's a simple yet effective indicator that complements the Alligator and fractal tools. Learning to interpret the AO can significantly improve your understanding of market momentum and trend strength, aiding in more accurate trade execution. And finally, we'll have an interactive Q&A sessions. If you have any question, this is your opportunity to ask a specific question, clarify and any doubts, and discuss the concepts we've covered. So engaging in these discussions will help consolidate your trading knowledge and ensure you can apply what you learned effectively. By the end of today's session, I hope you have a comprehensive understanding of Bill Williams' trading system, including the Alligator indicator, fractals, and the Awesome Oscillator. These tools and concepts will empower you to make more informed and strategic trading decisions. So I'm looking forward to engaging an informative session with all of you. Thank you for your attention, and let's get started. It's worth to mention that this webinar is brought to you by Aranta. We are an online broker committed to providing top-tier services and building lasting and trusting relationships with our clients and partners. Before we dive into today's content, please take a moment to read our general disclaimer. The information provided in this session is for educational purposes only and should not be considered as financial advice. Trading involves significant risk, and it's important to conduct your own research and seek professional guidance when necessary. Now, let's move on to the agenda. Okay, here's a recap from the last session. Alligator indicator is particularly useful for identifying trends and potential market reversals. Let's break down its components, understand how it works, and discuss some practical tips for using it effectively. Let's start with the structure or anatomy of the alligator indicator. The alligator consists of three smoothed moving averages, each with a specific period and forward shift. First, we have ellipse or the green line, as you see on this chart screenshot to the left. This is a 5-period moving average that is shifted forward by 3 bars. It represents short-term price movements and is very responsive to recent changes. Then we have TIF. This is an 8-period moving average shifted forward by 5 bars. It reflects medium-term price movements, smoothing out some of the short-term noise. And then we have jaw, or represented here with the blue line. This is a 13-period moving average shifted forward by 8 bars. It captures longer-term price movements, providing a broader view of the trend. These specific periods are part of the Fibonacci sequence, which is prevalent in nature and often used in technical analysis for its predictive qualities. The forward shifts help forecast future price movements and reduce the lag associated with traditional moving averages. But let's go through the interpretation of each line and understand how to interpret these lines during different market, let's say, states or phases. We have an uptrend when the green line is above the red line and the red line is above the blue line. Means the lips are above teeth and both are above jaw, and they're moving upwards. There is a positive slope. It indicates an uptrend. This is when the alligator is said to be feeding. Then we can identify downtrends when the order of the lines is opposite. Blue above red, red above green, and they're moving downwards. It indicates a downtrend. The alligator is also feeding, but in a bearish market. It's really important to note that when the lines are interlinked or not clearly trending upwards or downwards, the market is in a range or sideways movement. This is when the alligator is sleeping and trading should be avoided as the market lacks direction. Here is a practical tip. During a trending market, the alligator's lines will be clearly separated and moving in one direction. Use this as a confirmation of the trend. In a ranging market, the lines will be close together, indicating little to no trend. So let's look at an example here, as you see on my slide, to make this clear. On the chart, as you see, we have two phases: closed mouth and open mouth. Closed mouth, this is when the lines are close together, indicating a little to no trend. During this phase, it's better to stay out of the market as the alligator is sleeping. And when we have the open mouth, which usually happens when the lines are diverging, indicating the presence of a strong trend. This is the time to consider entering the market as the alligator is feeding somehow. So you see, very simple. It's really simple, and the alligator can demonstrate the market sentiment for us by using all of these three lines. But here is something that I really need to make it more clearer for all of us. Now we want to understand the rationale behind its unique setup. Why we have this? Let's talk about the significance of the numbers used in the alligator indicator. The alligator is composed of three smooth moving averages, as we mentioned, with a period of 5, 8, and 13. And these specific periods are chosen because they are part of the Fibonacci sequence. The Fibonacci sequence is a series of numbers where each number is the sum of the two preceding ones, such as 1, 1 plus 1 equals 2, 2 plus 1 is 3, 3 plus 2 is 5, 8, 13, and go on. And this sequence is prevalent in nature, and many traders believe it has predictive qualities in financial markets. That's why we see these numbers in the alligator indicator. For example, the 5 period or LIPS represents short-term price movements and is very responsive to recent changes, as we mentioned. Then we have the teeth, and which is reflecting medium-term price movements, and then we have a jaw. Okay, let's understand why these moving averages are shifted forward. The alligator indicator shifts the 5 period average forward by 3 bars, and 8 period by 5 bars, and the 13 period by 8 bars. Okay, why shift them? There are 3 main reasons. First, by shifting the moving averages forward, the alligator aims to forecast future price movements. This forward projection helps traders anticipate where the market might be headed rather than just reacting to past prices. Traditional moving averages often suffer from lag, meaning they react slowly to price changes. Shifting the moving averages forward helps reduce this lag, making the alligator more responsive to recent price movements. Also, the shifts create a more dynamic indicator. When the 3 lines, jaw, teeth, and lips, diverge and fan out, it provides a clear visual signal of trend strength and direction. And this makes it easier to identify trend changes early. So what does it mean for us as trader? Here are practical implication, let's say, of using the alligator indicator. The combination of these specific periods and their shifts helps to identify the beginning and ends of trends more effectively. When the lines are aligned and moving apart, it signals a strong trend. The separation created by the shifts provides a clearer visual representation of the trend strength and direction, helping traders to make more informed decisions. Also, by filtering out minor fluctuations and noise, the forward shifts reduce the likelihood of false signals known as whipsaws, which can be misleading in the trend following a strategy. So in summary, the alligator indicator utilizes the Fibonacci periods of 5, 8, and 13 and shift them forward to improve trend identification and reduce lag. And this setup makes it an effective tool for technical analysis, helping traders anticipate market movements more precisely and make more informed trading decisions. And here are the key benefits of using the Alligator indicator in technical analysis. This is a way, these are ways that we are going to use them and let's say uh, somehow include them in our trading strategies. First is the trend identification. The primary benefit of this indicator is that Alligator helps traders identify whether the market is trending or ranging. Okay, so when the jaw, teeth, and lips are intertwined, the market is in a range, or we say sleeping. When they're spread apart, the market is trending. Okay, so uh, this is the first one, and the application is that this assists traders in determining the appropriate strategy. If you can decide if you want to go with a trend following strategy or you're gonna trade a range. So it would be clear for you to choose your proper strategy to enter the market at that stage. And then also the Alligator provides clear entry and exit signals. You will see how with the lips cross above the teeth and jaw, it signals a potential buy opportunity if price is moving above all of the lines or out of the mouth of the alligator. Conversely, when the lips cross below the teeth and jaw, it signals a potential sell opportunity in the event that the price is moving below all the lines out of the mouth of the alligator. So it's a very, very clear identification of a new trend or the, let's say, the extension of the prior move in the market. So this helps us to time our trades more effectively and enhance decision making. Then we use Alligator to filter false signals by showing the states of the market like a trending or ranging. The Alligator can help filter out false signals generated by other indicators in non-trading markets. This reduces the likelihood of entering trades based on misleading signals, uh, sometimes let's say very late or very early, joining the market very late or very early, thereby improving the accuracy of our trades. We also use Alligator to measure the strength of the trend. That is a trend strength assessment is another primary benefit of using Alligator. The separation and angle of the jaw, teeth, and lips can indicate the strength of a trend. Wide separation suggests a strong trend, while convergence suggests the weakening trend. This allows us to gauge the momentum behind price movements and adjust our strategies accordingly. Also, we can use it with other indicators. The Alligator can be used effectively with other indicators such as the MACD, RSI, or fractals to convert signals and enhance trading strategies. Combining the Alligator with other tools provides a more, let's say, comprehensive analysis and improves the robustness of trading decisions. Now, let's see how we can add the Alligator to our chart. I hope you see my MetaTrader 4 here, okay? It's clear, very well, very good. So the first thing to do, open your trading platform like this and select the assets and open its chart. For example, what we have here, let's go to Euro USD on this daily chart maybe. Okay, here I have Euro USD on daily chart, and And now insert the alligator indicator from the Bill Williams indicator section in your navigator window. It's very easy. You can just find it here. Bill Williams, alligator, okay? And here is the interpreting the alligator. You see jaw at 13 period smoothed moving average shifted by 8 bars into the future, and we have a teeth and 8 period smoothed moving average shifted by 5 bars into the future, and then here is the lips, a 5 period smoothed moving average. So the type here, the method is simple. You can choose it to smoothed moving average, or you can use a different configuration of the moving averages here. And also it's worth to mention that these moving averages calculate based on the median price, which is the average of the high and low, or the average of the range of each candle, not the close price. Okay. However, you have the option to change it to what you wish to see which one is going better. It's your trading strategy, by the way, but the default setting is median price. And when you apply it and you see it's shifted 8, 5, and 3 here, and all of them are the Fibonacci sequence numbers. And then you can apply it very easy on your chart. And now, when the lips cross above the teeth and jaw, and the 3 lines start to spread apart, indicating an uptrend. Where we can see that, here is just at the beginning of the chart, we can identify this stage. Here we have lips crossing above teeth and jaw, and the price is moving above all of them. So when the lips, the green line, cross below the teeth and jaw, and the 3 lines start to spread apart, this indicates a downtrend. Where we can find this, somewhere like here. We have this green line crossing below the red line, which is teeth, and then blue line, which is jaw, and we see the price is moving below all the lines out of the alligator's mouth. So this is an indication of a new downtrend. So we can have an entry point maybe for a long position when the lips cross above the teeth and jaw, and the lines begin to diverge. Where can be that? For example, here is a very simple indication of the let's say alligator indicator, okay? Or for example, here you see as soon as the lips crosses above the jaw, we can watch the market to find a proper entry. Okay, we will discuss it in our next webinar, how to trade alligator in a very proper common trading strategies of different kinds. But here we are going to look only at the implication of alligator moving averages on our chart. And the sell signal is when the lips or green line crosses below the teeth and jaw, and the 3 lines start to spread apart, indicating a downtrend, something that we see has happened here when we see the lips just crossed below the jaw and the price is below all of them. This is it. There we can try to find a new entry, maybe at a break of the next support level. somewhere like here. Okay, but this is an indication of a downtrend. And now, based on that, now you can tell me what is the market direction like right now based on the alligator indicator. Just write it down to me. That's great. Yes, we are getting very good answers. Of course. And why is that? What's the reason? Sure. Okay. Okay, that's good to know that many of you answered this is an uptrend. This is the implication of an uptrend or upward movement in the market because we see the lips crossed above jaw and the price is above all the lines of the alligator out of the alligator's mouth. Okay, so this is the indication of an uptrend. I'm happy to get many right answers from you. That's great. Now, let's move forward. Let's focus on one of the three phases of the alligator indicator. We are going to have a more closer look at different stages or phases that alligator can illustrate for us in the market. And the first one we are going through is sleeping alligator. Understanding this phase is crucial for making informed trading decisions and avoiding false signals. Let's explore the details of this phase and discuss practical tips for using this information in your trading strategies. What is a sleeping alligator? In the sleeping alligator phase, the alligator's three lines, the lips, the green one, the teeth, the red one, and jaw, the blue one, are close together and running parallel to each other. This configuration indicates that the alligator is sleeping. On the chart here, you can see how the green, red, and blue lines are intertwined somehow and not diverging significantly. This lack of separation signifies a period of market consolidation. And the more important, on the top, we have the price, which is in the mouth of the alligator most of the time. And during this phase, price movements are typically narrow. Okay, and we see the market is in range bound. It's essential to recognize the setup to avoid entering trades based on false breakouts or that's what we called whipsaws. Instead, wait for the alligator to wake up and for the lines to start diverging, indicating the beginning of a new trend. See, what does it mean? When the alligator is sleeping, it means the market is not trending. Instead, it's in a consolidation phase. During this period, the price oscillates within a narrow range and there is no clear direction. So what should we do or what is the implications what is the implication of the sleeping alligator? First, the lack of a dominant trend makes it challenging to make profitable trades, so there is no trend in the market, and the market is gathering momentum, preparing for a potential breakout. So we shouldn't be disappointed if we see a sleeping alligator. It means the market is getting ready by gathering momentum and preparing for a potential breakout in the near future. So we can still say alarmed. We should use this consolidation period to prepare for the next move. Monitor other indicators, for example, such as volume or momentum oscillators, to spot early signs of a breakout. However, avoid entering trades based solely on the alligator during this phase because it would be really challenging. And it's real likely to get false signals. The key takeaway during the sleeping alligator phase is patience. Traders should wait for clear signals that the alligator is waking up. This occurs when the lines begin to diverge, signaling the start of a new trend. On the chart, observing the green line, let me bring it up somehow. Yeah, let me just move to lower time frame, like a 1 hour time frame, or even 15-minute time frame. This is, could be very, very, very helpful. This is a very, I think this is a very clear observation that we can take. When the green and red and blue lines start moving apart, this divergence indicates that the market is transitioning from a consolidation phase, okay, to a trending phase, but sets alerts or use automated trading systems to notify you when the alligator's line begin to diverge. This way, you can be ready to enter trades as soon as a new trend is confirmed. Additionally, consider combining the alligator with other technical indicators such as the relative strength index or RSI, or moving average convergence divergence or MACD, to confirm the trend and strengthen your trading strategy. While the sleeping alligator phase indicates a period of market consolidation, uh, please pay attention to this. It's really important to be aware of potential fake out situations where the price appears to break out but then reverses back into the range. To mitigate this risk, consider the following strategies. First, wait for confirmation. What do I mean by that? For example, at this level, you see we have a breakout to the upside, but then the price declined sharply to the other side. So we have to consider this breakout as a false break, okay? And to mitigate this risk, we need to consider some strategies. First, we need to wait for more confirmations. Look for multiple confirmations before entering a trade. For example, a confirmed breakout above a key resistance level like this, which increased the volume if you're trading stocks. But if you're trading Forex like me, you can just use another indicators like RSI or something. For example, you can see here that the RSI can't move higher, and there is it can be an indication of a false breakout. As you see, the RSI is shaping a double top above the 50 or the neutral zone, okay, in the buying region. And it's, you know, it's followed by this sharp decline in the price. And then because of that, we have to protect ourselves by setting proper stop loss just outside the consolidation range. This way, if the breakout fails, our losses will be minimized. And then we also have to monitor market news. Fundamental factors can trigger breakouts from consolidation. So keep an eye on economic news releases or significant events that might influence market sentiment. In summary, the sleeping alligator phase is a critical period of market consolidation. You can find this most of the time because the market is not always trending. Even during a very, let's say, during a very strong trend, you can see times of consolidation in the market. For example, somewhere like this or like this, when you see all lines are just moving closely and intervened. Or here. And it would be a very, very good practice for you if you just open your MetaTrader with me and try to point the let's say this sleeping alligator faces to see if you're getting it right and we are all on the same page or not. And you see, during the lack of enough momentum in the market or during the shift of market sentiment, we usually face the sleeping alligator. So it can be really useful if we include it in our trading strategies. However, next, we will be focusing on the hungry alligator phase. This phase is crucial as it signals the potential beginning of a strong trend, providing traders with excellent opportunities to enter the market. It's my favorite, guys, to be honest. Let's break down this phase in detail and discuss some practical tips for trading during this period. The first sign we get to identify hungry alligator is open mouth. The alligator lines are spaced apart. When the alligator is in the hungry phase, the three lines, the lips, green one, the teeth or the red line, and the jaw or blue line, begin to spread apart. This divergence is often referred to as the alligator opening its mouth. So on this chart, you can see how the green, the red, and the blue lines are moving away from each other. And this separation indicates that the market is transitioning from a consolidation phase to a trending phase. Watch for the lines to start diverging as a signal that a new trend is forming. This is your cue to prepare for potential trading opportunities. The more pronounced the divergence, the stronger the trend is likely to be. And this is a key point of analyzing the market using alligator, hungry alligator. But let's see, what does it mean? The alligator is ready to start a strong trend. The widening of the alligator's lines signifies that the market is gaining gaining momentum and is ready to enter a strong trend. This phase is critical for traders, for all of us looking to capitalize on new market movements. As an implication, I would say if the green line is above the red line, as you see here, yes, if the green line is above the red line and the red line is above the blue line, and all lines are moving upwards and the price is moving above all of the system, it indicates a bullish trend. See, we have a hungry alligator opening its mouth, and we have the price above all the components, and we see the order of lips, teeth, and jaw diverging from each other. So it can be indication of beginning a new uptrend. Conversely, let's find something like this here. Okay, if the blue line is above the red line, the jaw is above the teeth, and both of them are above the green line, which is lips, with all lines moving downwards with negative slope, it indicates a bearish trend. So confirm the trend direction using additional indicators can be really, really helpful. We can use a relative strength index or RSI or other moving averages or MACD. For example, in an uptrend, an RSI above 50 or a bullish MACD crossover can provide additional confirmation. For example, here, if we look at the RSI, we see as soon as the price breaks above the alligator, the RSI breaks above the neutral zone, entering into the buying zone or buying area. So it can be used as an let's say confirmation. Also, we can use MACD like this here, and you see as soon as the price established its new narrative, the upward narrative above the alligator's lines, we see a crossover between the MACD and the zero line. So this is a positive indication to confirm we are at the beginning of a new accelerating positive momentum or bullish momentum. And we have the same during the downtrends. We see during the beginning of this downtrend when we have the alligator, let's say, hungry or opening its mouth. We have the RSI also in breaking into a selling zone, and we have the MACD histogram just shortening below the signal line and the signal line crossing zero, which is a very strong confirmation of the accelerating bearish momentum in the market. And repeatedly, you can find this confirmation in the market when we have a new established trend above or even below the alligator lines. So it's really important to confirm the trend direction using these additional indicators. Important to mention that during the hungry alligator phase, the market is ripe for new trends, and traders should be vigilant for entry opportunities. This phase represents the alligator feeding onto market, and it's an ideal time to enter trades in the direction of the trend. And we will get back to this by developing a very strong trading strategy in our next webinar next week. But for now, notice the point on the chart where the lines begin to diverge and the price starts moving consistently in one direction. This is the signal to look for entry points. Okay, so entering the market after a confirmed divergence and trend direction can be in a bullish trend. You might enter a long position when the price pulls back slightly and then resumes its upward movement somewhere like this. Very nice, huh? But don't forget to use a stop loss orders to protect your trades. Place a stop loss just below the recent swing low in an uptrend or above the recent swing high in a downtrend to minimize potential losses, because understanding the market context is essential during the hungry alligator phase. Economic news, earnings reports, or geopolitical events even can significantly impact market trends. Always stay informed about major events that could influence market movements. And also, you better look at the fundamental analysis somehow to combine your technical analysis with fundamental narrative of the market to strengthen your trading decisions. For instance, positive economic data can further support a bullish trend indicated by the alligator, and that would be a better confirmation for you if we look back on the chart to what happens on Friday. If you remember the NFP day, okay, this is for today, but let's get back to Friday somehow. Was something like this. Yeah, see, what does it suggest to you? This a sleeping alligator with the price and lines intervene each other all the time, and this is a very, very tricky setup to enter the market. That's why the one major reason of that is the mixed data announcement. uh, on one side we had uh, better than expectation non-farm payrolls added in last month, but also we had a higher unemployment rates. This is a mixed narrative for the market, caused the price movements within a sleeping alligator without any clear, precise market direction or a breakout to any side, not downside or the upside. So you see, this is how you need to understand the market context when you use Alligator. Okay, so let's move forward and focus on the other phase of Alligator, which is awake Alligator phase. This is also crucial for capitalizing on strong and stable trends. Understanding this phase will help us identify and follow profitable market movements. Uh, Okay, in the awake alligator phase, the alligator's lines, the lips, teeth, and jaw are open and running parallel to each other in one direction, one clear direction. It's a very clean setup. Alignment indicates that the alligator is fully awake and feeding on the trend. On the chart, you can see the green, red, and blue lines moving in parallel. This configuration signifies a clear and a strong trend direction. When you see the alligator's lines open and parallel, it's a strong confirmation of the trend. This is the ideal time to enter trades in the direction of the trend. So ensure that the lines remain parallel to validate the trend's strength, and also the price is out of the mouth of the alligator, which is really important. The alignment of the alligator's line in the awake phase represents a strong and stable trend, whether it's an uptrend or a downtrend. For example, here you can see a very strong downtrend. The market is moving decisively in one direction, which here is a downside. So again, the green line above the red line, and the red line is above the blue line, with all lines moving upward. This is the implication of an uptrend. And the blue line is above the red line, and the red line is above the green line, with all lines moving downwards. This is the implication of a downtrend. Confirm the trend with other indicators also is crucial. But it's important to note that the awake alligator phase is the most favorable for traders. Okay, why? Because it indicates a period where the market trend is strong and stable, providing excellent opportunities to profit from the movement. So observe the points on the chart where the alligator lines are moving parallel and consistently in one direction. You can find it more likely on higher time frames. For example, here what we see is an awake alligator, okay? Or if we shift a bit to the past, you can see that here we have a awake alligator. Or even here, despite the price falling into the mouth of the alligator, we still have diverging lines in one clear direction, which is an indication of an uptrend. We have the lips above teeth and above jaw. and the price moving above all the system. So you can just scroll during the price history on your chart, and you can see how we can identify a very strong trend using Alligator awake phase. Okay. However, I would like to note this that during the awake alligator phase, it's essential to remain disciplined and avoid over trading. Here are some additional tips. Always use appropriate risk management techniques. Set your stop loss orders at strategic points to protect your capital. For instance, in an uptrend, place your stop loss below the most recent swing, for example, and avoid entering the market at the very late stages. When you see these very sharp upward movements and you see the price is in its let's say longest distance from the system, from the alligator lines, so it's better to be more cautious about entering the market. But we usually try to find our entry points when the alligator is let's say is awakening at the earliest stages, when we see the first divergence between the lines, which is the phase 2. Okay, now we are going to delve into a more advanced concept related to the alligator indicator, angulation. Understanding angulation can help you better interpret the strength and sustainability of market trends, providing a more nuanced view of market dynamics. Let's break it down what angulation is and how you can use it in your trading. And then we'll get into the interpretation of that. The definition. Okay, angulation refers to the angle or the degree of separation between the alligator's three lines, the lips, teeth, and jaws. Specifically, it measures the divergence and convergence of these lines, indicating the strength and potential continuation of a trend. Here is the two ways that we can measure the angulation. First, slope lines. The slope of the lines in the alligator indicator, like lips, teeth, and jaw, indicates the direction and strength of the trend. Positive slope when price is above the line suggests a going uptrend, as you saw, and a negative slope is prices moving below the alligator's line indicates a downtrend. Okay, but here is a tip. A steep slope suggests a strong trend, whether it's upward or downward. Monitor these slopes to gauge the trend's momentum. And the next one is angular lines. Angulation measures the angle between these moving averages. Larger angles indicate stronger trends, while smaller angles suggest weaker trends or consolidation. On the chart, angulation observed by looking at how sharply, let me bring my chart here, yes. For example, on a chart, let me make sure that everyone can see my chart. Okay, that's great, thank you for confirmation. Okay, so you see, angulation is observed by looking at how sharply the alligator's line are diverging from each other. A steep angle like this is the steep angle of divergence suggests a strong trend, while a shallow angle of convergence indicates a weaker trend or consolidation somehow. What we can see here, it usually happens at the end of a trend, and this usually happens at the beginning of a trend. So the positive angulation, when the lines diverge steeply moving away from each other, it indicates a strong and accelerating trend. And on the other side, we have a negative angulation when the lines converge or the angle becomes shallow. It signals a weakening trend or a potential reversal, as you see that happened afterward. So, as an interpretation of alligator lines, when the alligator's line intersects, it indicates the market is in a dormant state or lack a clear trend, something that you can see here. The tip here is avoid trading during this phase, as the market lacks direction and momentum. When the lines are open and parallel, it represents a strong and stable trend. This is an ideal time to trade in the direction of the trend. Confirm the trend's strength by observing the degree of separation between the lines. For example, you see at the beginning we have this slope for the jaw, and then it increases to this slope. And at the end stage, it decreases to a less slope on the chart. Okay. Also, we have the same story here on the downtrends. Doesn't matter if it's a downtrend or uptrend. You see, for example, during the phases of market correction, the slope, or let's say the slope of the moving averages usually getting smaller, and vice versa. So a steep angle between the lines indicates a strong trend. This is how we can identify a strong trend in the market. In an uptrend, for example, the green line should be significantly above the red line, which in turn is above the blue line. Enter trades in the direction of the steep angulation. Use trailing stops to protect profits while allowing the trade to grow. And shallow angulation, on the other hand, a low or shallow angle indicates a weak or no trend. During shallow angulation, consider avoiding trades or look for other confirming indicators before making a decision. And another thing that you can, let's say, look at them is the distance between lines. A large distance between the lines signals a strong trend, while a small distance suggests the market is not trading. You can understand it very easily by comparing a different trends. For example, when we are in this very mild downtrend, we have this slope, for example, and if we want to compare it, I just bring it to this, and here during this stronger downtrend, we have the steeper downtrend line here, or this steeper moving averages. And if also we measure the, for example, price movement is something from, let's say, this point to this point is something like 155 pips. And we can also measure it from this to this to see how much is it. And you see it's almost near 200 pips. In what duration, which is another important point for us, I'm just doing all of this drawing to illustrate the best implication that we can get from the alligator. Uh, don't expect it to be very precise. First of all, this is something that uh, happened here, but you can't expect it to be very precise on time on all chart setups. But here is just the let's say examination of that. This is 31 candles we have, and of course we need to have a shorter time. This is 25 candles. See, so the duration and the deepening of the price both suggest that this downtrend uh, or downward movement is much more stronger than the first one, this one above. So as you see, of course, the angulation, and if also we measure the distance between the lines and bring them here, you see here we have more significant separation between the lines or divergence between the lines. And here is another implication that we have a stronger downward movement here. And this is the way that we can compare the market momentum during a different movements. See, it wasn't that hard. Yep. Very well. So converging lines. Convergence of the lines indicates a decrease in trend strength, potentially signaling a reversal. So that's another useful piece of information that we can incorporate it in our trading strategy. As diverging lines usually indicate an increase in trend strength. So be cautious when the lines start converging and diverging, as it may be time to secure profits or tighten stop losses. Diverging lines suggest adding to your position. Okay, and the last thing we want to discuss on this slide is trend fragility. Large price resistance from steep angles indicates potential fragility in the trend. A practical tip here is to monitor these large distances closely. If the price starts to pull back significantly, it might indicate an upcoming reversal. So monitor the degree of angulation to gauge the strength of the current trend. Use it to adjust your trading strategy, let's say, such as tightening a stop loss or stop loss orders in a weakening trend, or adding to your position during the strengthening trend or strong trends. For example, you can see here after this clear awake stage of the alligator when the price is moving downward, very beautiful downtrend we have here, and then you see somehow we have this convergence between the lines, and this is the first indicator of losing momentum. But as the price is the best indicator is the market, we can gauge, wait for the price, and we can gauge the distance between the market bottoms to see how the momentum of the market has changed. And finally, when we see this higher top bottom here compared to this bottom, and this is a clear indication at this second candle after this bottom, we can identify it, and we see the price is moving into the mouth of the alligator with the lines converging compared to the healthiest stage of this downtrend. And this is a clear indication of losing steam of this downtrend. That's where we have to prepare ourselves for a market reversal. In this case, if we have had any let's say sell position, if we were shorting the market, this is a good place to close everything. Okay, and Also, we can wait for the market because this intervened price is not just it's not the stage that we like to enter the market. We have to wait for the alligator to open its mouth and awakening. And you see this sharp movement above the alligator system breaking this market top. The last market top here is accompanied by this very steep movement of moving averages here, which is an indication of a strong bullish momentum in the market. This is a strategy that we can explain in our next session. Unfortunately, I'm running out of time here and I can't go through more examples for that. Let me just get through the fractals. Fractals are a crucial concept in technical analysis used to identify potential reversal points in the market. By understanding fractals, you can better predict price movements and improve your trading strategies. So let's dive into what fractals are and how to identify them and their practical applications in trading. Okay. Okay, let's start with the definition of fractals. A fractal is a 5 candlestick pattern that helps traders identify potential reversal points. It consists of 5 candlesticks where the middle, here is, let's say, the middle candlestick is either the highest or lowest point, surrounded by 2 lower highs or higher lows on each side. And here's the application of fractals. Fractals are used to identify support and resistance levels. They can also signal potential market reversals, helping traders make informed decisions about entering or exiting trades. Use fractals to pinpoint key levels in the market where price action might change direction. Combine them with other indicators like Alligator and also other moving averages can give us a much stronger confirmation about the market direction and probable market breakouts. Okay, so let's get through the categories of fractals. First, you have high fractals. A high fractal occurs when the middle candlestick is higher than the 2 preceding and 2 succeeding candlestick. Okay, high fractals typically form at price ceiling, indicating resistance levels, and they signal a potential bearish reversal, suggesting that the upward trend may be coming to an end and a downward trend could start. When you spot a high fractal, look for confirmation from other indicators such as the RSI or MACD. But let's get through the low fractals as well. A low fractal occurs when the middle candlestick is lower than the 2 preceding and 2 succeeding candlesticks. This formation typically form at price floors, indicating support levels. We know this low fractal signal a potential bullish reversal in the price trend or price movement, suggesting that the downward trend may be coming to an end and an upward trend could start. When you identify a low fractal, use it as an alert to look for buying opportunities. Confirm the reversal with additional technical indicators like Bollinger Bands or stochastic oscillators to enhance the reliability of these trading setups. Okay, here's a tip I would like to make is about identifying trends using fractals. A series of high fractals forming at higher price levels can indicate a strong resistance zone. Conversely, if high fractals start forming at lower levels, it may signal the weakening of the bullish trend. Let's get to MetaTrader 4 and apply them on the chart. Okay, click on Insert menu at the top of the platform. This is an insert menu. You can go through the indicator. You can see we have Bill Williams here, and here is the fractals. This is a one way, and also you can go through the navigator window to apply the fractal. Okay, and here is a very simple. Let me just bold the line here to make it more clear. Okay, fractals will now appear on your chart as small up and down arrows above and below the candlesticks. Understanding fractals, as we explained, these are a type of indicator developed by Bill Williams to identify potential reversal points in the market. A fractal consists of 5 candlesticks or bars. Let's say candlesticks. We use it more. 2 preceding and 2 following candlesticks. Okay, so up fractal formed when the highest high is preceded by 2 lower highs and followed by 2 lower highs. So this is the highest high among 5 candle, and also this one, and also this one, and also this one, and this one, and here it is. Yeah, a bullish signal when an up fractal appears, it suggests a potential reversal from a downtrend to an uptrend. Okay, so we may consider it as a buy signal if we see a very clear breakout above the last up fractal. Okay, and the down fractal formed when the lowest low is preceded by 2 higher lows, and the shape of the body and shadows of the preceding and following candles doesn't matter at all. This is a big tip. For example, here we have, this is the lowest low among these 5 candles, 2 preceding and 2 following. Use fractals in conjunction with trend following indicators like moving averages. Fractals can help identify key support and resistance levels. As a tip you should know, during a downtrend, okay, and uptrends, each down fractal is acting like a support line, support level, and each up fractal can act as a resistance level. So if you put them, it's the easiest way to mark, let's say, the market pivot points. And during a downtrend, we expect the price to breach below the last down fractal. Okay, as you see, because we expect the sellers to reach all support levels to the down, okay, like this. And when a reversal is going to happen, we see the last fractal down is higher than the previous one. This is the first indication of losing steam. This downtrend is out of steam right now when we see the first down fractal which is higher than the last one, and this is the indication of losing momentum into downtrend. Okay, and now we count on these resistance levels as up fractal, okay? And we expect them to keep the price maybe to the down, which is in the zone of intense selling positions. But if this resistance level can't resist the market upward momentum, which means we are changing the sentiment and the market participants are rethinking about their position, and we are at the verge of entering a new trend. So you see what is happening at the beginning of a downtrend, and now you can just put it together with fractal here. We have a widening, let's say, angular lines here with formed by Alligator, and also we have the break of each down fractal, and then we have converging lines and the higher down fractal at the end of a downtrend. And this setup is repeating itself all the time. You can find it everywhere, at the beginning, at the down of the at the beginning and at the end of any downtrend. And also we have the opposite side for each uptrend. It's very obvious that during an uptrend we count on fractals, up fractals as a resistance levels, which are expected to not resist enough against the market bulls, okay, because we are in an uptrend, so we expect them to be broken. And on the other side, we have the down fractals as support levels, where we are going to put our stop loss when we enter the market in the direction of the prior trend. So, for example, suppose you are trading. This is the all things about the support and resistance levels during the trends. That fractals can help identify key support and resistance levels. Up fractals often indicate resistance levels, while down fractals indicate support levels, okay? Fractals also can be used to place stop loss orders for a buy position. Place the stop loss below a recent down fractal for a sell for a buy position, or above a up fractal for a sell position. Also enhance the reliability of fractals by combining them with other technical indicators like RSI, which can confirm the beginning of a new uptrend or downtrend by crossing above the 50 line from the neutral zone to selling zone or buying zone. As an example, suppose here we have a Euro USD. Let's find a good setup of the Euro USD. Okay, here is a good example, I guess. Okay, an up fractal formed at this level, which is 1.06, and this is a down fractal, and the up fractal forms at 1.07261. Okay, if the price breaks above the up fractal, as we see happened in this gap, with a strong momentum and volume, while we see the RSI confirming the upward momentum, and also the MACD by crossing the zero line is confirming this upward momentum, it might signal a bullish breakout suggesting a buy opportunity. In that case, we are going to put our stop loss here. It's going to be our stop loss here. And here is our entry level. And this is a reversal. You see it's a very clear head and shoulder pattern on this H4 time frame. When we see the last down fractal is higher than the previous down fractal. So breaking above the last up fractal, above the alligator system, while we expecting the lips crossing above the jaw, this is an indication of ongoing, let's say, uptrend or new uptrend in the market. So this is how we can trade using this to make sure that the alligator is confirming our entry. We need to wait for the price getting above, for the lips getting above the jaw. So that will give us a new entry point. So also we have the same during a downtrend. For example, here you see, as soon as we saw the matched, or let's say a lower up fractal during this phase of a sleeping alligator, breaking below the last down fractal here, and then we will be seeing that the lips are crossing below the jaw because it's shifted, you remember. So here can be, and we have the RSI confirming this setup, and we have the MACD crossing below the zero line. This is all indication of it starting a new downtrend, so we can have our entry somewhere almost here. For a sell position, and we can have our stop loss with a buffer above this resistance level. So this is how we can enter the market for a sell position. We have all the indication we need about a new downtrend. The price is below all the components of the alligator, and also we see the price is breaking below the last down fractal, which is expected to act as a strong support level here. So this it will be a good entry for us. And this is, as you see, it's really as simple as it is. Unfortunately, I get to the I'm running out of time, and I think that's enough for today. And I really appreciate your attention and your participation in this webinar today on Bill Williams technical analysis with Bill Williams. I hope you found the information valuable and insightful. Remember, mastering these tools and understanding market psychology can significantly enhance your trading strategies and outcomes. Please expect us next week with a thorough overview of different trading strategies using Alligator system. Thank you so much. Thanks again. Have a great day and happy trading.